Did you know that over 50% of dividend investors make mistakes that cost them thousands in lost returns? Don't let these common errors ruin your portfolio. Welcome back to Simply Money. Today we're talking about 3 dividend investing mistakes you might be making. Dividend investing is a powerful way to generate passive income, but it's not as simple as just picking high yield stocks. In this video, we'll uncover 3 major mistakes investors make and how to fix them. Many investors believe that all dividend stocks are great for passive income, but choosing the wrong ones can lead to reduced returns, dividend cuts, or even losses. Without a strategy, you could be setting yourself up for failure. Let's look at the 3 dividend investing mistakes. Mistake number 1, chasing high yields. A high dividend yield, 8% plus, sounds amazing, right? A high dividend yield can often be a red flag for a struggling company. Many investors buy AT&T for its 7% yield, only to see dividend cuts and a stock price decline. How you fix this is to focus on dividend growth rather than just yield. Look for companies with a history of increasing dividends like Johnson & Johnson or Procter & Gamble. Mistake number 2 is ignoring payout ratios. If a company pays out too much of its earnings in dividends, say 80% plus payout ratio, it may struggle to sustain payments. Here's an example. Companies like GE and Kutera had unsustainable payout ratios and eventually slashed their dividends. How do you fix this? Check the payout ratios. Aim for companies that keep it below 60% for sustainability. And mistake number 3, lack of diversification. Relying too much on a single sector, like REITs or energy stocks, makes your portfolio vulnerable. For example, during the 2020 oil crash, many high-yield energy stocks cut or eliminated their dividends. How do you fix this? You build a diversified portfolio across different sectors like healthcare, consumer goods, and tech to minimize the risk. That's why I invest in ETFs with strong yields, so they're paying a nice dividend yield, but they also have a large CAGR, compound annual growth rate, the amount that their dividend is growing over time. And I want to do this with ETFs that are diversified and properly balanced between different sectors, and they're also shown that their CAGR has been growing consistently for 10 plus years. That's why SCHD is one of my favorites. It's a 3.7% yield, 11% CAGR, and it's been increasing its dividend year over year for 12 plus years now. The biggest mistake is focusing only on yield instead of quality. A 4% dividend from a solid company with long-term growth is better than a 10% yield from a failing business. Avoid chasing high yields, ignoring payout ratios, and failing to diversify. These are the key to long-term success in dividend investing. What do you think? Are you invested in dividends? Have you been chasing high yield dividends? Share which ones you've been chasing down below and how have they worked out. And let's look at the historical facts from those different stocks or ETFs. I'm not telling you to buy SCHD. I'm not telling you to buy anything. I'm just giving you education to make wise decisions. Do your own due diligence. But these 3 mistakes are often causing dividend investors to lose money and to hurt their portfolios. What do you think of this video? Share, hit that like and subscribe button, and don't forget to hit that bell for notifications of future videos. I appreciate you joining me, and we'll see you next time on Simply Money.